cannot have a crash until something happens to overwhelm the passive bid. What is that something? A news event that's big enough to unwind other mechanical strategies that are bigger than the passive bid. Economic weakness such that the money coming in from new employees starts to shrink, and what's going out for employees leaving the workforce, and therefore reducing the money in the index funds changes that. If that were to happen, you could have a crash. I mean, the structure of the market would allow for a crash easily, but the preconditions to get it started, something to get it rolling, is very difficult given the construct that's put it up here, which is the passive bid and all the attendant mechanical strategies. So the market is as a structure crash prone, but trying to the things needed to get at that, to sort of break the machine, if you will, it's a pretty high bar to get over. The purpose of talking about it is so people understand that while it looks easy and everything looks rosy, there's a big problem beneath the surface. And, if Trump this weekend would have said, hey, we're doubling down, we're serious, you could have had a huge down opening. It could have fed on itself. And we could have seen the futures limit down by Wednesday. I mean, so that's how things could play out. Now, it didn't, but that doesn't mean it couldn't next time.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Bill Fleckenstein. So Bill is a professional money manager with over 30 years of experience. He writes a daily column and is the author of Greenspan's Bubble, The Age of Ignorance at the Federal Reserve. So Bill, thanks so much for coming back on the podcast.
Well, thanks for having me back.
No problem. Happy to have you. I think we spoke 6 months ago, and it feels like years. I probably say this with every guest, but so much stuff has been happening. I feel like every day there's a new thing, and we've probably become desensitized to it. But I'd really be interested in hearing more about your current thoughts on what we're seeing in the economy and markets at the moment.
Well, it's hard if you're talking about how you might implement my thoughts or anyone else's in the so-called stock market. It's pretty difficult when so much of it is consumed by the passive / mechanical bid and flows that are all oriented that way, the retail speculation, the ODTE options, and then we have Trump creating headline roulette on a regular basis. Friday he makes everyone think he's going to get super serious with the Chinese. Then over the weekend he says, haha, just kidding. And, so it's an incredibly difficult environment because of all that volatility and the upside pressure that's mechanical. So the higher it goes, the more risk the prices have because of the nature of the beast. But there's nothing really to upset the apple cart unless you get into a situation like Friday or last spring, where a piece of news comes along and catches a lot of these mechanical strategies overloaded and they have to sell, and it's bigger than the passive bid. And then you can get real weakness feeding on itself, which we saw Friday. And we saw last spring lasted a couple of weeks, but a lot of damage was done. So the market structure is incredibly brittle, but it takes a lot to change or to upset that. In the economy kind of muddles along. People with assets are doing fine. Kids out of college or people that are low income are struggling. We still have inflation problems, and there are some credit problems starting to show up beneath the surface. So I think the economy is kind of muddling along. I think if we weren't running a 5% or 6% budget deficit and the stock market wasn't hitting new highs regularly, the economy would be far weaker. But that's kind of where we are right now.
Yeah, okay, really interesting. And as you're saying, the indexes is actually, the passive bids. It's amazing as well because these indexes are becoming basically the same thing. You look at the Nasdaq, I think it's 70%, Mag 7. You look at the S&P, it's almost 45%. So it's actually these, they're just going together. Yeah,
it's basically devolved into a gambling machine, pretty much. You've got the passive bid running in the background, which kind of keeps things going, and then you have wild speculation. So it's like there's much more binariness to the market these days than there ever was, say, 10, 15 or more years ago.
Yeah, yeah, the constant buybacks from companies as well. So it just seems like you have this
Well,
constant bid.
yeah, but the buyback is a little bit, you know, the buyback is a function of offsetting the dilution created by stock option grants. So yes, there are buybacks, but yes, there's plenty of stock issuance that goes on in the form of compensation. So the tech companies can report earnings stronger than they would be able to if they were forced to actually compensate their employees with cash.
Okay, yeah, that's a good point, especially for the tech companies. It seems like their stock options is their go-to mechanism of incentivizing employees. But yeah, so we saw this volatility on Friday, as you said, and I think a lot of it went through the crypto markets. I think the sort of the traditional markets grabbed it at the end. Do you see something like that being able to, because I think it went 20, there's billions liquidated, massive panic in that market. Do you see that being, potentially going to the S&P and
Well, I think there's a
traditional
lesson.
markets?
It's possible, but not like what we saw. I mean, I think the problem in the crypto world is that there are a lot of these entities that allow people to have accounts where they can get wildly leveraged, right? I don't pay close attention, but I read enough stories this weekend where people were, or some entities were allowing to have 20, 30, 40, 50 times leverage. And, if you have 20 times leverage, a 5% move will kill you. Well, and the way these crypto things bounce around, because remember, most of they're just like concepts. I mean, they're not tied to anything. And so, unfortunately, a lot of people got badly hurt. And hopefully the people will learn a lesson. But given the gambling mentality that we see today, I'm not sure, what kind of lessons people are actually going to draw. Maybe they'll just think, oh, it's bad luck, as opposed to when you're, basically what they're doing is they're betting on red or black on leverage. So it's not shocking that it came to a bad end.
Yeah, and as you're saying, with the sort of 0-day contracts or these very short contracts, is sort of options. It seems like that's
but what I'm talking about is the speculation in general,
yeah.
right? I mean, it's just there people are betting on kind of binary outcomes, even though it doesn't quite look that way, and they're using leverage, and that's a recipe for disaster.
Yeah, great point. And I think it is this thing where you mentioned that certain people aren't benefiting from this current economy, even though it's meant to be sort of roaring, and growth is at close to 4%, apparently in the US. But you see, I guess younger people who don't have assets, they're not. So it's for them, it's almost like a financial nihilism. I'm not sure if you heard that, where they're sort of just like, oh, I need a way out. I need a lottery ticket. Let's put it all in. But then they're going to get.
Yeah, I mean, and I think the troubles that they face are legitimate. But I can remember when I was in my late 20s trying to buy a house. Interest rates were, in the teens, in the early 80s. And I remember I was a computer software programmer and I was making $800 a month, so it hasn't always been easy for everybody. I see a lot of people saying that, the boomers did this and did that. Well, I mean, it wasn't like no one who's in that age cohort didn't face difficult times along the way. But so what I'm saying is, despite the difficult hand people to have to play, I don't think gambling is the solution to that problem. That's what I'm trying to say. And though it's tempting, and especially when you see a lot of your friends doing it and making it money, it seems easy, then other people join in, and that's how you get to a place where you can get, so many people get wiped out in a weekend, like what happened this weekend.
Yeah, great point. And do you actually think the economy is strong? Is it just being driven, as you said, as a government deficit? There seems to be this weird circular economy and AI where they're just sort of shifting equity and money around.
AI is driving a certain amount of economic activity in that one specific sector, but away from that, I think the economy, and the deficit, given its size, helps people to get the transfer payments and the other money the government spends, and people with assets are doing fine. But yeah, I think the economy is just kind of okayish. And it really depends on what your station in life is, and all of that as to how weak or strong the economy feels.
Okay, so you don't see, I guess, a lot of people calling for a crash, or they're calling for maybe economic issues. But is that something that you're seeing on the horizon, or not
Well,
really.
you cannot have a crash until something happens to overwhelm the passive bid. What is that something? A news event that's big enough to unwind other mechanical strategies that are bigger than the passive bid. Economic weakness such that the money coming in from new employees starts to shrink, and what's going out for employees leaving the workforce, and therefore reducing the money in the index funds changes that. If that were to happen, you could have a crash. I mean, the structure of the market would allow for a crash easily, but the preconditions to get it started, something to get it rolling, is very difficult given the construct that's put it up here, which is the passive bid and all the attendant mechanical strategies. So the market is as a structure crash prone, but trying to the things needed to get at that, to sort of break the machine, if you will, it's a pretty high bar to get over. So the purpose of talking about it is so people understand that while it looks easy and everything looks rosy, there's a big problem beneath the surface. And, if Trump this weekend would have said, hey, we're doubling down, we're serious, you could have had a huge down opening and could have fed on itself. And we could have seen the futures limit down by Wednesday. I mean, so that's how things could play out. Now, it didn't, but that doesn't mean it couldn't next time. So this is not to say, okay, everybody run for the hills. It's understand what's really at work here and be prepared such that if that starts to change and looks like we're heading into a real problem, that you know what you're going to do about it. Because we could have had this conversation a year ago. In fact, I probably might have said similar things 6 months ago. But it doesn't mean that because these risks are present that they're going to manifest themselves or cause a problem just because they're there. They could go on for quite a while. But you need to know what the environment is that you're operating in so that you'll have a game plan if things start to change.
Yeah, great point. And how do you have the game plans? Do you sort of have different scenarios and different?
Well, I've chosen to carry more cash this year because I thought that the unpredictability of Trump would make for some, wild times, and we've seen some of that. I own a fairly healthy chunk of gold and gold miners, so I'm protected against cash debasement. I've got a few individual securities that I think the businesses can do okay regardless of the environment because of the way they're set up. And then I'm prepared to short things to hedge out the market exposure to what I own if it starts to go that way. So Friday, I shorted some Qs and had a pretty good profit heading into the weekend. Most of it was there for protection. I wasn't really trying to make money. And then, everything got solved over the weekend. So I bought it back, for a teeny tiny loss. And so my plan is I will get short various things to protect my other investments if I see things start to come undone. I was sensitive to the fact that the way the market broke on Friday on the news, it could feed on itself, which it did. So that's the point in understanding the script, such that so if something like that happens again, you'll know not to expect a bounce. Now, we could be in a different spot mechanically, like we were last spring after enough people have been flushed, that when the all clear sign came from Trump, we had this massive rally that's taken place over the last 5 months. But that wouldn't be the case today because there's not enough of the mechanical speculative money that got washed out just yet. Anyway, the point is you have to understand the rules of the game that you're actually playing and not think that the game is whatever you think it is.
Yeah, it's a great point. And you mentioned debasement there, and it seems to be a big trend of it's amazing what we've seen with gold, one of the best performing assets this year, silver as well. But then it's funny because, bonds yields are actually coming down. So it does seem like it's a very weird dynamic currently at the moment from a asset perspective and a correlation perspective. How do you see that situation?
Well, the bulk of the bid in gold has been from central banks and from Asia, not from America. And you can see the speculative interest in gold or gold miners. The shares outstanding for the GDX are down in the year. The GLD has increased its shares outstanding, but they're below where it was a couple of years ago. My point is, there's not wild speculation on the part of Americans. If you look at the open interest of the gold contract, it's where is it? 485. So if for 90, it's kind of in the middle of the road as to where exposure gets. It's closer to the lower end than it is the higher end, but it's kind of in the middle of the road. So there's not really any evidence of really strong speculation on the part of Americans. The people chasing, fusion stocks and crypto-oriented ideas and other speculative concepts really aren't in the gold market. Now, if they got in the gold market and the mining market, there'd be quite a party. But then there would also that would also mean that we might be close. We'd have to start thinking about maybe being closer to the end of the movie than we are now.
Yeah, okay, great point. And yeah, so you said obviously prices have gone up, but there's not that speculation euphoria that you'd expect at sort of a peak.
Certainly not in America. That's not to say that's not the case in Asia, but
yeah, okay, yeah, great point. See what happens, but yeah, I guess from a bonds perspective, I think you touched on it there, but yeah, do you see that it seems to be sort of going the other way? Do you think that's sort of a trend reversal, or do you think it's sort of just a lull in the meantime?
I don't think the bond market. I just don't believe the bond market can rally all that much more. I mean, the Debasement has moved the funding to the closer more to the short end. They've unhandcuffed the banks so that they can own more short-dated treasury paper, and so the bond market's kind of behaved itself. But I think the trend is going to be for higher rates because the Fed rate cuts I think will change inflation expectations. So I'm not short bonds because it doesn't quite seem like the right moment. But if you said to me, you have to either buy them or short them and hold them for 6 months, I'd take the short side.
Okay, so you think, yeah, what would you wait for to then go short? Is it just sort of the market dynamics?
I don't know.
No, what you see once you see it, yeah.
Something will happen and make me think, okay, maybe I should try a small position, and it might start to work, and I get bigger. I don't know, weakness in the dollar. I don't know, market action itself. I mean, people may not have paid attention, but we've now cut rates three times in the last 13 months, and from 7 years and out, rates are slightly higher. Now they were a fair bit higher. We've just had a rally in the bond part of the curve, but rates are still up from where the 125. Whereas rates were cut 125 basis points in the overnight rate, and you'd think the whole curve would come down, but just the short end came down and the long end just kind of sat there. So far, the bond market hasn't really validated the rate cuts.
Yeah, that's probably going more to, I guess, a standardized bond market because that's how it should be. The longer date should be sort of a little bit higher versus shorter end.
Yeah, my point is that when they cut rates, they only got the short end of the curve to cooperate. The long end of the curve didn't cooperate. That's my point. So you'd think if the bond market was all for the rate cuts, the entire curve should have come down. But what happened was the short end came down and the longer end kind of stayed there or went up a little bit. That's what I'm saying. That's the early sign that maybe the bond market isn't on board with these rate cuts. Now we'll have to see how it plays out from here.
Yes. Do you think the Fed could actually lose the sort of bond market, lose control of it?
I believe they will in the end. I believe they will for sure. And then they'll resort to yield curve control. But that's not today's trade or today's issue. But yes, I think that's where we're headed. I think at some point that's exactly what will happen.
Okay. And yield, I guess they have sort of been doing, I guess, not yield curve control with pulling the issuance forward further forward on the curve. But you think it'd be a lot more, solid yield curve control, or could it even just be QE where they're sort of artificially?
Well, I mean, yield curve control is QE. It just the difference is it's unlimited, right? They say, okay, we're not going to let rates from 7 years and out trade above 4. We'll buy unlimited supply. I mean, the Japanese just did it. We did it here in America in the late 40s, 40s and from the mid 40s to the early 50s. It's basically unlimited QE is what it is. and they do that to make sure that the longer rates don't rise when the market wants them to rise. So usually you wind up with a weak currency in that. But again, we'll have to see how it plays out.
Yeah, and I guess in that scenario, as long as there's no inflation, then they can sort of continue to.
Well, that's the
do
problem.
That yeah.
But that's the problem. There is inflation, and the inflation mentality is strong because prices are have still gone up, roughly 100, up a huge amount versus where they were a few years ago, and they're not coming back down, with the exception of oil and maybe a few other oddball things. Prices are still elevated. So while the rate of change of price increases is only going up at a couple percent, 2, 3, or 4, depending on what month, or those price hikes that people have experienced in the last couple of years are still there. Now, so if that were to change for a protracted period of time, a couple of years, you might be able to wring out this inflation psychology that has reemerged and is going to be hard to get rid of. Most people underestimate the power of that inflation psychology because they haven't seen it. But I saw it in the late 70s, early 80s, and then it kind of went away until the mismanagement of monetary policy during COVID, and that brought it back in spades. And now everyone gets it, and they're sensitized to it. And so that's why the bond market's going to have a problem, I believe, is because when the Fed continues to ease, at some point there'll be more inflation relative to the coupons, and the bond market won't cooperate. But that's my theory. We'll have to see if it plays out that way.
Yeah, from your own perspective, how long do you think it will take for that inflation mindset to sort of dissipate and to people to go back?
Several years. Several years. Yeah.
Okay. So yeah, and I guess we're still at 3% in the US.
That's what happened in the 80s. Now maybe it take a little less time. I don't know. We'll have to see, but it takes time.
Yeah, and we're still at 3%. At the moment. So do you feel like that's enough? It's sort of lukewarm, but it's not sort of boiling. If you think about a frog in the water, it's sort of not killing.
Yeah, but that's 3% on top of last year, on top of the year before, on top of the year before, on top of the year before. So it's not just 3%. That's the way the politicians and the government want to spin it, and the Fed wants to spin it. But that's not what people feel when they go buy things. They're still paying the full price of all the cumulative effects of the hikes, and they get that reinforced every time they go buy something. So they're not going to change their view of that because, without some big change in policy or a change in their lived experience.
Yeah, and it seems like deflation, it's very unlikely. You might get disinflation, but as you said, that continues to compound on top of what we've already had.
Right.
Yep.
So, no, I'm just going to say that psychological component is a big deal, I believe.
Yeah, really important. And do you buy into the, there's all this talk about AI and how it could be quite a large deflationary sort of impact on the economy and through production?
Well, it's going to be a large deflationary impact on a lot of companies' P&Ls when they have to start expensing the cost that they've capitalized, and there's no return on their investment. But that's going to be a few years down the road. I don't think AI is going to wipe out every job like all these people say. No, I think that what's going to get wiped out is balance sheets and P&Ls of the providers of this stuff as when we get further down the road. There's not possible to get ROI on the massive amounts of money they're planning to spend, because there's no real chargeable end market. I mean, the best thing about AI, one of the best things, is that it's made search a lot cleaner, and you don't have to fight through so many ads. So it's been a net negative for Google, if you ask me.
Yeah, definitely. And I guess the only time it will come is if they can somehow charge companies. It will be corporate if they can charge companies to replace employees. But will that happen?
We'll have to see. I mean,
yeah, definitely. Is there anything else that you're currently watching that's interesting you from an asset perspective, or is it mainly just the sort of the gold and the gold miners that you're in?
Yeah, other than individual stocks that businesses I happen to like. I mean, again, I think you have to plan for the fact that it's a very tricky period, and it's got a lot of things could go wrong. So you need to have businesses that have certain dynamic or catalysts that don't have anything to do with pure economic activity.
Okay, and what would that be? Sort of more the sort of fairer, more resilient companies, no matter what the
Well, yeah,
economy.
they're very idiosyncratic. I own a company called Pure Cycle Technology that recycles polypropylene, and they're the first company to be able to do this. And they're just now getting um, they're in contract negotiations with people who've tested their products, and they've just they've proved that their factory and and the concept works, and they're going to be stepping out to other facilities. And obviously, if you can turn post-consumer plastic into virgin plastic without remelting it down or shredding it mechanically, then you have a pretty insatiable demand, and there's no real competition for them, nor is there likely to be. So that's the kind of business that I think can grow regardless of what happens in the environment, because the demand for this thing that they can do is going to be pretty insatiable for the next decade, I would think.
Yeah, okay, really interesting. So as you're saying, it's a stock by stock, very specific story narrative.
Totally,
Yeah.
totally idiosyncratic. Yeah.
Yeah. No, great point. So, Bill, thanks so much for your time today. We sort of covered so many different avenues. But my last question is, what is one message you want people to take away from our conversation?
Well, I think the thing I harped on in the beginning is, just because everything seems to be going along well now, and it seems easy to make money, you have to understand the structure of the market that we're in, and what could go wrong, and what would make it go wrong, and what you're going to do to stay out of trouble if things do start to go wrong. That's my message.
Great, perfect, great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Well, I have a presence on Twitter. My handle is @FleckCap. And then I have my website where I write my daily column. It's fleckensteincapital.com.
Perfect, great. I'll put it in the description below, but thanks again for your time.
Okay, take it easy.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.